The metric we tend to look at is essentially looking at the productivity, the efficiency in the business. What AI should allow you to do is not get rid of your whole team. It's grow your business with less resource. And that it can be any kind of resource, but especially human resource. What AI now does, it's going to evolve. It's more generative AI, lets you produce things, create things. So the idea is you're looking at what you want to do is see your revenue to your administrative costs.
Today, we've got Piers Linney with us. Why you're in AI and how you're going to measure that.
Metrics in the world of artificial intelligence is going to be...
Welcome to Founder Metrics by Vested, the podcast where we dive into the world of hotshot business leaders and the metrics that drive their game-changing companies forward. I'm your host, Ifti Nasser, CEO and founder of Vested. Hi, I'm Ifti, and this is Founder Metrics. Today, we've got Piers Linney with us. Piers, welcome. Do you want to give us a little bit of a background to your journey to being here, from lawyer to...
So very quickly, I am mixed heritage, mum's from Barbados, dad's from Manchester. I grew up in the north of England, comprehensive school kid, wanted to go into business. I've been in business since I was a teenager, really, in various different things. I was always in business, and I managed to get through into university. I became a lawyer. So already now, I'm a lawyer in the city, which is quite a journey from where I came from, my school in this mill town. Then after I became an investment banker at Credit Suisse when it was solvent. And then after that, I went into sort of business, really, dot-coms, technology, media, telecoms, sort of web 1.0, and then I kind of went into finance for quite a while, really. So I kind of missed web 2 in many ways. Then I ended up building businesses, investing in businesses, exited some of them, some successfully, some not so successfully in some cases. And I'm still at it, really. I'm still starting businesses, investing in businesses, and building businesses.
So shall we take these in two chunks? Firstly, as a banker, when you were looking at businesses as a banker, what was important to you?
So what always struck me is that I did a degree, a 4-year degree in law and accounting. Right, people don't know that about me. I think I'm just some bloke off telly, fast talking guy off telly. But I'm actually a professional banker and venture capital lawyer. There's a textbook called Brearley and Myers, and this is like the corporate finance Bible. It was at that point. And I learned about corporate finance theory. And in no theory, it's about here are some inputs, here's a theory or formula, and that gives you an output. And what I realised in banking was you had a formula, you knew what the output needed to be, and you went and found the inputs in many cases where you kept tweaking them, or tweak the margin or tweak the growth until the output looked right, whatever formula you were using, or you just tweak the formula, very complicated kind of discounted cash flows and economic value.
Which is easy to do in a spreadsheet. You just
easy in a
change the number.
spreadsheet, just to change the synergies or the number of people you can take out, this kind of stuff. So I learned. My degree was in accounting, so I understood a P&L, a balance sheet, a cash flow, and those interrelationships. But banking really gave me the understanding of how you apply that in the real world. So at that point, it wasn't really sort of the kind of metrics you often hear about with sort of tech companies these days. It was more your typical accounting metrics, looking down a P&L and a balance sheet and how the interrelationships. And I did a lot of M&A and a lot of leveraged buyouts. So leveraged buyouts involves a lot of debt. So a lot of the modelling wasn't just here's a P&L and balance sheet, here's another one, merge them together, take out the synergies, and then put the debt in. And what does the debt look like, and how do you model the debt over, potentially 20, 30 years?
Yeah. I mean, that's crazy, especially when you think about, lots of things are easy to do on a spreadsheet, as we just mentioned. 20, 30 years is easy, but real life is about the day-to-day, especially running a business. When you're running a business, you need to be able to see how the next 6 months are going to run. When you were investing in businesses, was this the next 6 months or the next 12 months the most important for you, or was it that 20-year discounted cash flow that was the key?
So it always depends on a lot of the oxygen gets sucked out of the room with tech companies, which is a particular way of looking at things, because you're trying to, have metrics to show you can go and raise the next round of finance, et cetera, whereas a vast majority of companies, they're not on that rail track. And it also depends on at what stage of business you're looking at. So if it's a really new business, I mean, a startup has no metrics. You're looking at the founder, essentially.
Well, they must have some metric.
Yeah, the metrics, their CV, and they're standing in front of you. And can you think you can work with these people? So there are metrics, but they're not things you can probably add up. And other businesses I've been involved in where we've done acquisitions. So I've acquired quite a few businesses with other businesses. And they're businesses that have, people, profits, customers. And that's very different. You're looking at the due diligence is looking at, you're basing evaluation on certain metrics, and your due diligence is checking that the background to those metrics is actually correct and it is what it should be. So depending on where the business is, if you were buying a utility business, God forbid, it's more about regulatory risk as opposed to the actual the metric. The metrics are important, but it's a very, very different. And in a young company, you lose your management team or your key shareholders. They're not vested.
Thanks for the plug there.
You've got a massive problem. If you lost the whole management team of a big utility company, some awful air crash, it won't matter. You just replace them and carry on. So the metrics depend on where the business. People make the mistake often that they just hear about and understand particular metrics and they try and apply it to a whole range of different businesses, and you can't always do that. I mean, there are some similarities because most businesses have the same dynamics, but in most cases you need to be quite careful about what it is you're looking for.
Yeah, and I guess that's part of what I'm trying to get out of these podcasts for founders, because as a banker, you'll have tried to look at everybody in a uniform manner. There was certain pieces of information that you'd look at, and there it would allow you to make your decisions or choices as to either invest or buy or whatever the gig was.
Well, so just on that, so as a banker, what you tended to be looking at were the metrics that enabled you to value a business. Because we were doing M&A, so it was mergers and acquisitions. So it was always an evaluation conversation. So the question is what are the numbers you believe this business can produce over a period of time, and then what metrics, evaluation metrics, comparable company, comparable analysis, DCF, economic value added. You can keep going. What multiples is a good example. Do you then apply to those numbers to achieve a valuation that you believe in?
Yeah, I guess so. That's the difference. So when, as a founder, as a business founder, let's say, for instance, in Atherton Bikes, what are the things that are there that you're looking for as a founder so it can help you anticipate, predict how you're going to manage the next 6 months, year of your business? Because they're quite different, I would imagine.
Yeah, so Atherton Bikes has been quite interesting because it's my first foray really into production. Now, don't get me wrong, I'm not involved in the production, the team are, but so you can imagine that you've got your sort of sales and marketing, yeah, and whether you're selling a bike or you're selling some SaaS, it can look quite similar in terms of your performance marketing and your social media and where you're going to try and find these customers, doing podcasts, whatever it might be, and but then you get into the delivering the product or service. So in a SaaS company, it's sort of technology, delivering, shipping things. Yeah. But in Atherton Bikes, for example, you get into shipping in carbon fibre and constructing the lugs, the joints on the bike.
Logistics as well.
Well, logistics, supply chains. That's quite a new thing to me. Most supply chains are is the developer awake? Yeah. So now you're into supply chain, which was quite complicated during COVID, as you can imagine. Yeah. And a production, and then when somebody orders a bike, for example, there's an enormous complicated process to actually have something that's finished and can be shipped at the end. And in that production process, you're not quite complicated enough to have just in time. But the beauty of the manufacturing process that we have is that you don't really have stock, because we're manufacturing bikes to order, and we're manufacturing them to people's. We have like over 20 different sizes. We can make it specifically for the individual, so we're not carrying stock. Now, if you are carrying stock, then understanding the metrics that relate to your inventory, your stock, whatever you want to call it, depending where you are, really matters, because that can kill you, because that's just cash tied up. So it's been an interesting one for me, is working out in a production process. What are the metrics that mean that you're on track, you're on time, your materials are right, your costs of goods sold are right, even the price of titanium powder. Yeah. We have to discuss this kind of thing. So that's been fascinating for me. That's been quite new. But essentially, as I said, most businesses, the dynamics are very, very similar, especially down to your sales and marketing can be very, very similar. Yeah. After that, they can change dramatically.
But going back to what you're saying about that you're not doing just in time. But what is the lead time from an order? Because as you said, they're made to order to the exit of the bike from the factory.
It's a couple of months. So that's quite normal.
That's still tied up assets in process.
Well, you've still got, so you imagine a bike, right?
Yeah.
So, when you look at a bike, for example, we don't make the whole bike. We make the frame.
Mm-hmm.
So then all the other parts, the OEM, the forks, the pedals, the seat, everything else is kind of bought in. So that is inventory. Now, luckily, the founders and myself have got a great relationship with those suppliers. So you've been able to kind of manage that. But anything like that, you can find yourself. And what I found quite interesting with founders quite often, I had this conversation last week. And when was it? Yeah, last week. And they're killing it. They're growing quickly. They're like, oh, we're smashing it. We're winning all these things. I'm kind of like, right, what are their payment terms? Like, oh, well, they can be, 45 days. And I'm kind of like, right. So you do realize that growing at that pace is going to kill you. Because you just that 45 days you've got to pay people today essentially.
Absolutely,
it's going to kill you. And they all look at each other thinking, and they kind of see the penny drop. That over trading,
cash flow is absolutely critical.
And without looking at how you're going to fill that hole, and as you were saying, having that model. So with me, I'm going to ask you a question. Yeah, you want a business plan that's looking out 3 years, but depending on where you are in that growth sort of trajectory, after 6 months, it can be like a fog where it means nothing. If you're a bit further down the line, like your business, for example, you can probably got a good idea that in 12, 18, 3 years even, where you
3 years is probably still hazy.
Then you get a fog.
A year forward, I think we're pretty solid on. But
so any investor that's sitting with you, especially in early stage businesses, and is asking you in some detail, well, do you really think you're going to hit that EBITDA number in year 4? Go and find a different investor. So the model, so as a banker, I can still write quite complicated financial models for my sins, but it's not because you're trying to pin down that number. Mm-hmm. What you're trying to understand that what are the levers.
Yeah, absolutely. So, I mean, building models, whether it's financial models or business models, it's about being able to assess that future.
Your model's not
critical.
Yeah, it's the logic that matters.
Yeah.
So if I pull this lever here, if I can negotiate another 2% with my suppliers and increase my margin here, does that fall straight through to the bottom line? If I do, what's that bottom line look like? And if I apply this multiple, what value does it create? So that's the thing that people often kind of miss. Don't get lost in the numbers, get lost in the logic.
I think that's brilliant. But being able to build your own model and understand which different levers you believe you have, but also from the model, you may be able to also determine which levers you need to create. Because being able, when you know things, you're talking about the pace of growth and cash flow being a key one. If it is your terms, the payment terms, then that may well be the biggest thing to move for the business team to survive.
You can have, because you can in a model, an Excel spreadsheet, whatever you use, you can have too many levers. So, for example, if you're building a bike, whatever it might be, you've got all these parts. So you can actually model the margin, the cost of goods sold on every single part, which is fine. And you could do that if you wanted to. But over time, you're going to learn on average what you're looking at in terms of what you're going to make, what it's going to cost you on average for, maybe you divide them into, suspension or braking or, whatever, gears, whatever it might be. And then you break it down. But having too many levers sometimes can make it too confusing.
Well, you're not getting to the right metrics. So, to have 100 metrics, to have 100 levers, you're spending all your time just pulling and pushing levers. You, as a founder, I would argue, need to know the, at most, handful that are critical to your specific business.
Or at least know what the target outcome should be. Like, for example, you might say, like, this business, and no one's going to invest in this business, or I can't really exit it for the valuation I want, the multiple I want, unless my margin is 50%, let's pick a number, GP margin, and maybe 30% down at EBITDA. So you now know that you've got to hit those kind of numbers, not just for your own business, but just to be comparable with other business in your sector.
Yeah.
And ideally, you want to be better, so it should be higher. All right. So ideally, you want higher growth, higher margins, therefore you're worth more. And if you understand that, you can then work towards and bringing metrics help you work towards that outcome.
Yeah, I think that's key, because there are metrics that you're going to have, certainly if you're going down the investment route, that are going to allow people to compare you against others, because cash is cash. It has a multiple of options to be deployed, and you need to be able to compare relative to those. But the things within your business that you can move to get to those numbers, those metrics correct, I think is the key for every founder to understand. So when you look at Atherton Bikes, that's, as you say, it's not bricks and mortar, but it's real tangible stuff. One of the other businesses that you're involved in, and certainly that you seem to be showing a great deal of interest in now, is AI. That's totally the other end of tangibility, or is it? Can you help us understand why you're in AI and how you're going to measure that?
There's a lot of noise in AI. Mm-hmm. So this business is called Implement AI. So there's a clue in the name. Mm-hmm. So I was looking at, do I invest in technology? Do you develop technology? But it's moving so quickly that, you ship something on Friday, be on a date by Monday.
Yeah.
And my view is that a lot of SaaS companies are going to be squeezed out. They're becoming a thinner and thinner layer on top of these models and these platforms. And I thought, in the old adage of the Californian gold rush, the people who make the real money, they're ones selling shovels. So it was more about how do you help businesses understand how they implement this technology. Now, going back to metrics though, the metric we tend to look at, he's not formally a mentor, but I meet him every 6 months, is Sir Ken Alissa.
Right.
And I was talking about Implement AI, and he was saying, well, the metric, Piers, you should be looking at is essentially looking at the productivity, the efficiency in the business. What AI should allow you to do is not get rid of your whole team. Mm-hmm. It's grow your business with less resource. And it can be any kind of resource, but especially human resource. Mm-hmm. What this stuff does, what AI now does, it's going to evolve. It's more generative AI, lets you produce things, create things. So the idea is you're looking at what you want to do is see your revenue to your administrative costs. So that's a key metric we're looking at in AI. It's not your gross profit margin, which is your, I'll keep, I hope anyone's sucking eggs here, but it's your kind of revenue, and then you take off your cost of sales, cost of goods sold, gives you a gross profit margin. What's that margin? It's not your sort of operating margin, your EBIT, that's after your administrative expense. It is, as you grow, are you adding in a linear fashion the same amount or similar amount of administrative expenses? Yeah. And if you're not, your margin is going to increase, and the value of your business is going to increase. It means you're more productive, more efficient. So in our model, in our framework, people say to us, what's the metric you're looking at? Yeah, clearly, I want to help you be more productive, content marketing, growth. Yeah. That's an easy one in terms of artificial intelligence. But overall, the longer term one is great. I mean, he was the other day, they were saying that you're probably going to see your first, unicorn with 3 employees and just loads of agents doing stuff. So if you get to that level, you imagine the margin. It's ridiculous, because in most companies, as we know, the main cost is still people. Yeah. I think Ahmad, Mustak, was saying, the founder of Stability AI the other day, saying there'll be no one coding in 5 years. So the world is going to change fundamentally. Yeah. And my view is if you're in business, you've got to get on, I call it this boat, because it's leaving the harbour. And once it's got so far out of harbour, you can't make the leap, and you never will be able to make the leap. It's over.
I think that's really interesting. You talked about SaaS. I mean, that's what SaaS was. SaaS was that first piece of very low team, but serving big numbers of customers, and you were able to use software to service more without increasing the team in a linear manner, as you said now. I mean, that ability with AI, we're already seeing it in a number of the tools that we're using at Vested. But that piece, you just made it feel really real. Your boat analogy took it to reality.
The issue with SaaS is, you think about it, I use the it's like a triangle, isn't it,
Yeah.
right? And I think this triangle has been filled with technology. It was all humans.
Yeah.
It was us, a spear, and our dog, right? And it's been filled now. The first industrial revolution, second, the third was the web and digital. Now you've got the fourth, which is intelligence. So any business now, you need to have electricity, you need to have connectivity, you need to have intelligence. And SaaS really has kind of owned the top of that triangle for a lot. And the cloud technology helped that. These platforms,
Yeah.
didn't have to manage it and host it yourself, which was a bit of a nightmare. And I was kind of one of the quite early into cloud. But SaaS, if you think about a bell curve, if you're a SaaS company, you want to aim for the middle of that bell curve, the largest, totally, the addressable market, obtainable market, essentially. You're not really designed for the edge cases. And then what they then tend to do, if you're, I don't know, a sales automation SaaS, you think, well, why don't we do customer service? And if you're a customer service SaaS, why don't we do sales automation? And while we're here, let's do content marketing. And suddenly they're kind of doing all this other stuff in a sort of half-baked way. With AI, the difference is, I call it kind of micro SaaS. You look at your business, look at your workflows, look at the automation, look at these models you've got, and you build applications almost. It will evolve very quickly over time. They've got to be quite lightweight, that are specific to your business and adding value. So they add far more value, and you can take a very large SaaS and upload everything it knows, all of its documentation, all of its FAQ into an LLM, and ask it questions. Now you've replicated the SaaS. So I think that these thousands of AI-related SaaS companies you see are a very thin layer on top of these models that I think over time companies will squeeze out. I mean, how many times can you spend 20 quid a month on a SaaS? To do something you're going to be able to do with natural language interaction within a year.
And in terms of these two businesses that you have, obviously, there's no SaaS on either side. There's the AI and there's the bikes. I guess the bikes.
Well, I'm
are
involved in a space
for-
business, so we're putting satellites. I mean, imagine this one just is a 4K video of all of Earth in real time eventually. So that's quite an interesting one in terms of those metrics, because that's very different, because you can't sort of say, your first few satellites are more, although they cost millions, are kind of like MVP. You can't really talk about, revenue or acquisition costs quite yet, because until you've got a much more, a larger constellation, your revenue model isn't quite there yet, and the use cases. So you're kind of selling the future in many ways. Your metrics in many ways are not the typical ones. It's more about progress and electronics and electronic development and testing. And is this thing got flight heritage now? Does a particular use case work? Does this particular functionality work? So it's more milestones of the metrics as opposed to financials.
Yeah. I mean, again, as we said earlier, not all metrics for businesses are financial. There are other things, and it's all about indication. For me, it's about the indications that help the founder understand whether they're in the right place or not, and what they need to change to get them into that right place. But the space business
SaaS,
is an
though,
interesting one.
But the beauty of SaaS is that there's a very clearly defined model of what people are. If you're on the track to raise multiple rounds of venture capital finance, right? There's a way of doing it in terms of what you need to do. There's a process, essentially, MVP, product market fit, MRI, you need to growth, blah, blah, blah. And they're looking for reasonably traditional sort of metrics, really. So you kind of know. If you've got a business which is slightly more complex or new, like the space business, because it doesn't exist, then understanding what the metrics are, initially at least, can be quite tricky.
So for you, what are those first metrics for the space?
Kind of business? Well, I don't run it, so it's more the visionary founder Charles. But so the metrics have been really it's been milestones really. But now you've got a satellite. We are now starting to talk to media companies. Think about having real video of Earth. Trading, media, education, humanitarian. The list goes on and on and on. So we're now talking to different businesses where there's a use case to try and sort of prove the use case in a way. And then once you've done that, and you'll get feedback about it in terms of is the content right? Do you change the way you deliver the content? Do you even change the hardware in the next satellite, for example? Yeah. It's that kind of feedback loop. And then once you've proven that, and then you get into more of a sales cycle, and then you get into traditional sales metrics. And a lot of people have grown up, especially in SaaS companies, with performance marketing, digital marketing, content marketing. And I've spent a lot of my career in B2B sales where you send people around in an Audi, right? And one thing I've learned from that is that most people don't really understand a sales process, because it's always been sort of kind of on the internet in many ways. It's a landing page and looking at conversion. Yeah. Whereas if you've got people in the business where, I don't know about your business, you potentially, I don't know, if you get to bigger companies, someone's going to have to go around there and talk to them. And then you get into a very different sales process that you need to manage and understand, have a pipeline, be able to risk adjust the pipeline, manage the people. And if you don't have the metrics, you can't manage the salespeople.
Yeah, absolutely. I guess it depends on the nature of the sale, the complexity of the sale. I think you're absolutely right. I think up until about 10 years ago, everybody was in an Audi, for want of a better phrase, or a better car. And I guess over the last 10 years, everything's gone online. The question is, to what degree and to what type of businesses will it go offline? Will the online essentially just be managed by AI, because it can analyse and assess so much more effectively than any of the humans? Because going back to the data sets, you can have millions of data sets. Even Google Analytics will provide lots and lots of info for you. But
now you've piqued my imagination.
AI
because what's going to happen? So you imagine. That's what she's the ones people know, right? ChatGPT, yeah. So a lot of these language models now have got context windows where you can dump in there 20,000 words, right? A few more in terms of tokens, but let's call it 20,000 words, which is a decent book. So if you think about, if you can now there's APIs, and you can now feed into that, maybe not into the actual LLM clearly, but more database it can actually talk to, a huge amount of data, more data than you could ever comprehend. You know, forget your human dashboards where there's like three things going, dials and things going up and down, tachometer style. It's a different kettle of fish. So what's going to happen is you're going to have an agent that represents you that wants answers, and you're going to have the information, maybe another agent that specializes in like ChatGPT, can't really get in the UK so much, but it's called Code Interpreter. And it will look at data and start to assimilate it and understand it and tell you things about the data that you never even thought of. So you'll have another agent that understands the data, one that's what you want to know, what you need to know. They'll talk and produce data and metrics and insights that you've never even dreamt of.
Absolutely. I mean, I don't know if you've read Sapiens, but there's an example in there where they set an objective for an AI, and it actually was able to, it's driven by marketing, but the whole notion that you can identify bipolar, the onset of bipolar in an individual, and then if you actually send them a link to buying airline tickets between Los Angeles and Las Vegas, that was the most, and I'm not sure how the correlation came to pass, but you could, as soon as you found that characteristic, you just kept sending the opportunity to buy tickets to that characteristic of individual. And actually the characteristic that the AI had identified was essentially
on a sales
onset
call,
of
video sales call, and you can do sentiment analysis just from I mean, you can't do this out of the box quite yet, but looking at people's expressions and the tone of voice and what they say and the words they use. So you can do a video call now and have a really good idea where they are and the kind of are they going to buy or not, and have you got to answer some more questions to close them down, whatever that looks like. So I think that metrics is going to change in that there's going to be a huge amount of data that can now be analysed, because most metrics, let's face it, what they're trying to do is whittle down and understand a business with as few numbers as possible.
Yeah, it's and to give you insights, not just data.
Exactly.
It's to give you insights such that you can drive actions.
AI will end that, because you can have you can. I mean, this is going to be interesting for investors, because they could ask a company or its data set almost anything. So you never quite know what the answer is going to be. With the metrics today, you kind of know, well, you produce them, and you deliver them,
Yeah.
and they'll check them. Where if you've got a language model attached to a database, understand your business on all your information, and the investor can say, just give us access. And then that'll be quite interesting.
That ultimately could be, it could be the way of the future of investing, because
well, they can automate it.
You just put, whether it's your CRM or whether it's even your app and the data that it's capturing.
I mean, some do that. Some do that now.
Yeah,
but this is a different league. So I think that, I wasn't expecting to go here, but metrics in the world of artificial intelligence is going to be very, very hard to actually understand for a lot of people. So you might have to come back to, because there's metrics, there's insights, right? And there's day-to-day metrics of running a business. So if you sit down in front of your marketing team, your salesperson going around in the Audi, what metrics am I using to manage the business? And then you might have OKRs, and you break them down into what does that mean in terms of metrics to manage you.
Thank you for joining us on this episode of Founder Metrics. Remember, even the biggest of ambitions are within your reach when you leverage the right strategies and metrics. If you enjoyed this episode, be sure to subscribe and never miss a future episode. You can visit vested.com, Founder Metrics, for additional resources, articles, and exclusive content. Join our growing community of entrepreneurs and founders by following us on LinkedIn or X. We'd love to hear your thoughts. Together, let's continue to unlock the metrics of success, sharing, and create a brighter future.